Good afternoon and welcome to another GemCap Academy. It's my pleasure this afternoon to welcome Chris Stapleton, one of the founding partners of AMCS, which is based in Miami, the USA. Welcome, Chris, and thank you for visiting the UK.
Thank you, Stuart. It's a pleasure to be here.
And how's things in the US post-Trump election?
Well,
exciting times.
Nothing short of active. I'll just leave it at that.
Yes.
I think there's been more news flow in the last 2 weeks than we had in a few years. But
I think the journalists are keeping busy, aren't they?
Yeah, they are. They are indeed.
Now we're going to talk today about the US offshore and the Latin American, South American market.
Sure.
Now, a number of the managers we work with and managers globally tend to focus on London and Europe. It seems to be their sort of area, their expertise. They want to go there. But what are they missing by ignoring the US offshore and the South American story?
Yeah, it's a great question. I think, if you think about the overall UCITS opportunity set, right? I mean, multi-trillion dollar, I don't know how many trillions of dollars in UCITS in Europe, but a fair bit. Obviously, Asia as well. By comparison, the Latin American U.S. offshore market isn't massive by the numbers. I mean, we're talking, probably $300 billion-ish in terms of addressable assets, but it does have some unique features that make it attractive for European managers. I think, first and foremost, unlike the onshore sort of 40 Act market in the U.S., you can address the market with your UCITS funds, right? So you don't need a massive, sales force. You don't need a product suite registered in the U.S. You can obviously open your office, hire your own salespeople. You can partner with somebody like us. But by and large, for the right capabilities that the market favors, you can certainly take advantage of, what's I would say is a much easier addressable market than the U.S. wider U.S. wealth market.
And when we talk about U.S. offshore, what markets are we talking about specifically?
In terms of geography?
Geography, yeah.
Yeah, it's a great question. So, I mean, the U.S. offshore market really exists on the basis that, I'll preface that, Latin America makes up probably about 80% of investors who put their money in the United States. But equally, you have EMEA investors and also Asian investors who use the United States as a booking center. I think the U.S. is now the third or fourth largest booking center after Switzerland, Hong Kong, and Singapore.
Wow.
It's actually surpassed the UK and the Channel Islands. Okay. No offense, I hope. But essentially, you have about 80% of that market made up from Latin American investors. And the reasons that Latin American investors seek out the U.S. as a booking center are probably quite obvious. Geopolitical instability, economic stability in their own countries and their own currencies. So having an account in dollars in the United States with a reputable financial institution is attractive to high net worth, ultra high net worth individuals.
Okay. And when we talk about Latin America, obviously we're talking about the peninsula of South America, but we're also talking about the islands. So we're talking about Bermuda, Cayman. And
yeah, I mean,
BVI.
a bit. I would say, and I know I didn't address your geography question, so let me just, get back to that quickly. So Miami, far and away, is the largest offshore booking center in terms of where advisors are located within the United States. Other markets of interest would be probably New York is number 2. And then gateway cities to Mexico and Texas and California. And then actually in kind of Northern California, kind of Los Angeles and San Francisco, you actually have a number of Asian-focused advisors, typically expats from China, from Hong Kong, from Singapore, et cetera, that cover the Asian market on a fly-in, fly-out basis. So that's a bit smaller, but it's actually one of the fastest growing segments within the U.S. offshore market.
Now you're based in Miami.
And Montevideo.
And Montevideo?
Yes.
Uruguay?
Correct.
Lovely. Well, clearly the South American market, be it Uruguay, Argentina, Brazil, I guess the main markets, Chile, Peru. Can you give them some hierarchy?
Yeah, I mean, let's kind of divide the region in half. So you have an institutional market that buys UCITS funds in Latin America, right? So you have the Andean pension funds that include Chile, Peru, and Colombia. They tend to have similar buying habits. They're looking for large, highly scaled strategies, top quartile performance and consistent performance. You need to maintain that performance to keep the money. And they will work with large global asset managers, U.S. asset managers, but also more niche players from Europe, assuming the funds meet the size and performance criteria.
Okay.
So that is approximately about a third of the overall, what I would call UCITS opportunity set. Mexico is also a big pension market, the Afores in Mexico. UCITS in the last 18 to 24 months have actually kind of become an approved investment vehicle, and you're starting to see some early allocations there. But historically, ETFs and segregated mandates have been more the typical vehicle for allocation from Mexico.
Okay. Talking on product, we spoke before we went live here, is that we talked about the demise of the US mutual fund market in favor of the active ETF market.
It's a long funeral, yeah.
It's a long funeral, and I remember talking about this some years ago. So it has been quite a progress. We have seen here in Europe a significant rise in active ETFs.
Sure.
Do you see or foresee a situation where active ETFs dominate the market in the US offshore South American market over UCITS? How do you see it panning out over the next few years?
Increasingly, they're becoming more relevant. So when I think about active ETFs, I mean, certainly in the US onshore side, if you think about fund structures, the active ETF, the interval fund, they are increasingly becoming the vehicle of choice versus the traditional sort of open-ended 40 Act. In the offshore world, I would say it's a little bit slower, although some of the largest players in the market in terms of distributors are having pretty significant growth in the offshore ETF space, but I would say principally in the passive space. But when I speak to some of the largest global asset managers, they're sort of telling me that new product development going forward, both in 40 Act as well as in the UCITS world, is going to favor the active ETF structure. Now, the ETF is great in some regards, obviously intraday pricing. I think for the client, there's tax benefits obviously to having the ETF as well. Where it gets a little bit complicated is on the distribution side, because you don't have the visibility in terms of in a mutual fund, the shareholder record keeping is with the transfer agent or the omnibus provider of the distributor, and you get to see all that information on a daily basis, who your clients are. With an ETF, you're reliant on your distribution partners to provide that. And the rumor is that some of them charge for that information.
No surprise there. I mean, whenever there's opportunity, somebody will charge. There's no doubt about it. And I think
absolutely.
We've seen that in Europe, where we've seen sort of the big houses launching very successful active ETFs, but the second tier is struggling because they don't have the distribution capability, whereas the big boys can go out there and sell it.
Correct.
They don't need to worry about who's buying it because it's their collective. Whereas the smaller houses, particularly using third-party distribution agents, like firms like yourselves, how do they allocate that investment which came from, say, Switzerland, when actually it could be placed by somebody in Italy or it could be placed by someone in Spain, and the TPM won't get the allocation? Do you see that changing? Do you see that the visibility, or are we going to be having to put our hands in our pockets and pay for that visibility?
I think, unfortunately, you're really hamstrung by your distribution partners in terms of getting that visibility. I mean, I don't profess to be an expert in the space. We're not currently distributing active ETFs, but several of our partners are in active discussions about launching them. In fact, a discussion I actually had in the city today is whether, if you're thinking about active ETFs, whether you work with a partner to structure the fund or you build it yourself. And it wasn't really a conundrum that I had given too much consideration to, but essentially when you work with a partner, you're obviously paying away a lot of your margin at the outset, whereas if you structure your fund as an asset manager, you sort of take it on the nose at the outset in terms of costs, but long term, if you're successful, you're going to have higher margin.
Yeah, the only caveat to that, of course, is you're talking probably about £1 million just to set something up like that, because you've got the key individuals are going to be expensive, the structuring around is going to be expensive. So a boutique manager isn't going to front that. So they're going to have to find a third-party solution.
And maybe once you get it to scale, you can bring it in-house. I mean,
absolutely, yeah. But that's the same with many fund managers, who from a distribution point of view,
Sure.
who look after that. Now, let's touch on AMCS because you've been very successful. You work with some of the biggest players globally, which is quite different from a lot of your competitors who tend to work towards the boutiques.
Sure.
Why have you done that? And more importantly, it's clearly been successful for you and for them. What makes it work for you and not the other way around?
Yeah, it's a great question, Stuart. And if you were to ask me, 6-7 years ago before we set up AMCS, if you asked me to idealize a third-party distributor, it would be exactly what you said, working with small, high-alpha boutiques that don't have the distribution resource or wherewithal to kind of go it on their own. In our case, we're partnering with AXA IM, Jupiter, and Man Group. Obviously, big names, particularly here in the UK. And the reason behind that really is, from our standpoint, the barrier to entry to get on global platforms and wirehouses in the US, sort of post GFC, has gotten much higher. So all of these institutions, whereas 20 years ago you'd sign a selling agreement, you'd take the product manager out to dinner, and all of a sudden your 20-odd funds would appear on the platform magically the next day. In today's environment, you are kind of bound to have initial and ongoing due diligence for every single fund that goes on a platform. Yeah. So what that basically means, it's cost and resource to the distributors, and they are not going to just onboard any old strategy. So for AMCS, when we wanted to quickly get our business to scale, which we've been fortunate to do in the last couple of years, it really required working with partners who were, in a way, big enough to have the brand recognition, but small enough that they would choose to work with specialists in the U.S. offshore and Latin America market. Okay. Jupiter, AXA, and Man all have flags in the U.S., boots on the ground on the U.S. institutional side. Okay. So working with us is more of a decision of, not committing a huge amount of overhead to having an offshore sales distribution, outsourcing some degree of risk in the sense that my team are squaring off on the on the distribution. We don't intermediate the asset flow, but it's my team that are out there kind of with their regulatory license in terms of positioning the funds, et cetera. So they have a bit of risk mitigation, and generally are getting access to a team of specialists.
Sure. Now, you've chosen that route with your business, AMCS. What makes you choose a manager? What are you looking for when a manager? Because I've introduced a couple of managers to you over the last few years. You've chosen not to go with them for various reasons, but what is it that you're looking for in a manager to onboard them to AMCS?
Well, I think first and foremost, it's ticking the boxes on categories that are relevant in our market, right? So I think especially in today's world, the kind of regionalization of buying more kind of granular sector and countries and so on and so forth, there's opportunities there, but they're very niche and they're quite small. So when I think about our business, core global equity, core fixed income, core multi-asset, those are the biggest sort of what I would call bulge bracket categories, and that's where we want to be active. And I think we've been very fortunate with the partners that we have to build out a nice sort of core capabilities across the three firms. Going forward, and now that we've been able to get to a degree of scale, we can look at more specific granular stuff, more of those sort of boutique type names, potentially more in the private market space. So if I think about the future of AMCS, could we add one more big global brand? Potentially, but I think you're more likely to see us shifting to more specialty products. Sort of the vision that I would have idealized at the outset, but we can't do that without revenues, and we've had to build the business based on those big firms.
And is it, going back, if I may, just to the sort of geography of the region, exotic that it is, and you kind of gave me some ideas about Argentina and the trip that I did recently, and thank you for that.
You did that trip just in time, by the way. The cost would be about double if you were doing it this year.
It was still more expensive than when you went. But it was lovely, steak and Malbec. Thoroughly recommend Argentina. But are there big differences between the Miami and the US offshore in that sense and the South American? Because I see Argentina as a country which tends to send its monies through Madrid, for whatever, you walk around Madrid these days, there's lots of people who are from Argentina.
Yeah.
I
Great
see
city.
great city, but are there differences, and therefore are there differences in requirements as far as product?
Sure.
As in, is it credit more required in one particular market, or equities or emerging market? What are the regional differences that you see?
Yeah, I mean they're subtle, but there are differences, and I'll explain a little bit about why that is. So in the U.S. Offshore market, that space is dominated by a handful of global financial institutions, wirehouses. You know the name: Citi, J.P.
Yeah,
Morgan, UBS, Morgan Stanley,
yeah,
Merrill's, etc. When you move into Latin America, kind of post GFC, a lot of those banks exited the region.
right.
Due mainly to the cost of doing business from a compliance standpoint, simplification of their businesses, et cetera. So you've had this massive vacuum that's been filled by independent advisory firms, right? And just a few names: Insignio, Bolton. I mean, these are firms that have kind of hoovered up a lot of former wirehouse advisors who were in the region. So that independent model is different than a wirehouse in the States in terms of the products and services that are offered. It's very open architecture, so they have access to everything, but they don't always have the same degree of kind of house view guidance, asset allocation. I mean, there's an exception to that, I would say, with one of the larger independent players. But so I think when you're selling in that market, the advisor is more reliant on your advice as a salesperson,
Right.
rather than them necessarily getting spoon fed from the house.
Got you. And do you see much change in the geopolitical situation post Trump now? Is there any dynamic there where you feel that your business will suffer or actually improve as a result of Trump politics? It's a tough question to ask.
Yeah, I mean, look,
I
I would say it's very early days. We'll see. I think from a U.S. standpoint, the potential for deregulation, for shifts in the tax code that are more favorable to business. Those dynamics would help entities like ours and our distributors as well. So that could be positive. Equally, there's a lot of talk about tariffs these days. Are they just bludgeoning instruments, or is it really economic policy? I think it sort of remains to be seen. But that obviously brings a degree of instability into markets, and where that takes us, I guess we'll find out in due course.
Well, hopefully we'll see you next time you're over, and we can catch up on that. But for now, thank you very much, Chris.
The pleasure, Stuart. Thank you.
All the best.